Hello, I'm your professor, Dr. Stephen Haggard, and today we're going to talk about whether you should pay off your mortgage early. So you hear a lot of these personal finance gurus talk about the need to pay off all your debt as soon as you possibly can. And to some extent I live my life like that. I pay cash for cars, and if I can't afford to pay cash for a car, I wait until I can. Cars last a long time anymore. But there's one kind of debt that I'm not in a hurry to pay off, and that's mortgage debt. And here's why. First of all, mortgage rates in the United States are artificially low because of interference from the government through Fannie Mae and Freddie Mac. Mortgage interest is also low because of the secured nature of the debt. Of course, that's one of the reasons they're telling you to pay off your mortgage, because if you don't pay it, if you eventually miss some payments, then you could lose your house. But in the meantime, that security means that you pay less interest on that loan because it's less risky for the lender. Another thing, if you itemize your taxes, your mortgage interest is tax deductible. And that's not true about the interest that you would pay on a car loan, which, by the way, is typically a higher interest anyway. And so there are lots of things that work together to make mortgage funds a really cheap source of funds for you. And so the question is, should I pay those off quickly, or is there something better that I might be able to do with those funds? And so today I want to talk through a couple of things with you about what you can do with any extra money you might have that might make more sense than paying off your mortgage early. So let's say that you have an extra $100. Your marginal tax rate is 20%. And what that means is you actually had to earn $125 in order to be able to keep $100, which was 80%, meaning the tax was 20%. And so now you've got this $100. And let's assume that your mortgage rate is 4%. But remember, your mortgage is tax deductible, your mortgage interest. And so you're going to end up with a situation here where you're actually really only paying 3.2% because of the tax savings that brings. How did I get 3.2%? It's your mortgage rate times 1 minus the tax rate. Why minus the tax rate? Because of the tax deduction for mortgage interest. And so here we've got a 3.2% mortgage in essence, and I can pay that down by $100. And that's going to save me a grand total of $3.20 per year. Now that's a certain savings. There's no risk to that at all. And so we can at least give it that paying down this mortgage is a certain return on your money. However, what if we were to take that $125 that we earned pre-tax and put it into an IRA? And what if we invested that IRA in the S&P 500? Now, the S&P 500 might have recently had some rough times, but on average, we're looking at around 10% return on the S&P 500. And so what is 10% of 125? It's $12.50. So on average, we could expect that $125 to create an additional $12.50 in returns in our IRA every year. So what would you rather have? The $3.20 from paying down your mortgage, or the $12.50 from paying down your IRA? Now some of you are going to say, wait a minute, you're going to have to pay taxes on that IRA when you pull that money out. Now that's true. But let's ask this. How high would the tax rate have to be for it to be a better deal for you to pay off that mortgage than to put the money in your IRA? What if tax rates were 50%? You'd still have $6.25 versus $3.20. And so it really makes a lot of sense to work these numbers out for your own situation. Figure out what your own marginal tax rate is. By the way, if you use TurboTax, I think it actually tells you on that little summary page about your taxes. It tells you your average tax rate and it tells you your marginal tax rate. But you can always figure it out just by looking at the tax forms. By the way, what is your marginal tax rate? It's the tax rate you would pay on the very next dollar earned. So that's the tax rate that we're talking about. Okay, now there might be other reasons that people want to pay off their mortgage early. I grew up in a farming community. I am the grandson of a farmer. And farmers and other types of folks like real estate brokers, they have volatile income. In other words, one year might be great and the next year might be really bad. And the more volatile your income is, the less you can afford to have high fixed payments. High fixed payments that might come from debt. And so for these people, it makes a lot of sense, perhaps, that they pay down their mortgage. In fact, that was the goal of almost everyone that I knew growing up, as the goal was to pay down the mortgage as fast as possible. But it all came from this vestigial farmer gene that we had that made us think that our cash flows would always be volatile. Well, now I'm a tenured professor. I would have to do something really bad to lose my job. So my cash flows are fairly steady and fairly safe. And so a person like me could afford a higher monthly fixed payment than someone who was perhaps farming or selling real estate. Keep in mind that when we're talking about this paying off your mortgage early as a way to reduce your risk, that we say in finance, you can either sleep or you can eat, but you can't do both. Now, what does that mean? If I want to be safe and pay this mortgage down fast, then that allows me perhaps to sleep better, but I don't get the kind of returns that would allow me to eat better. And so always think about that. There's always this trade-off between risk and return. Okay, so let's also think about a potential other use for your funds. What about your rainy day fund? According to a recent survey by bankrate.com, only 39% of Americans have at least $1,000 set aside that they can use to handle emergencies. Only 39%. That means the other 61% are hanging out there without that ability. Also, that same survey said that 34% of Americans had experienced such an emergency in the last year. Now, I would be willing to bet money that not all of those emergencies happened to the 39% who had the money socked away. And so that would lead to financial distress. And so one thing you might do with this money that might be better than paying off your mortgage or putting money into your IRA would be to put it into your rainy day fund and be ready for that emergency that comes up. Life's financial surprises are hardly ever positive. They're usually negative. And we know that life is full of surprises. So if I were you, I would put together a rainy day fund before I started paying down my mortgage or even saving for retirement. Okay, now let's talk about advice. Advice is like stock. You want to keep a diversified portfolio. I've given you some advice today. These financial gurus have given you advice. And I want you to take all that advice and go through it and see what makes sense to you and what doesn't. And the right answer for one person could be different than the right answer for another person. And so please think closely about your own situation before you figure out what to do with that spare $100. If you like this video, please hit that like button If you want to subscribe, that would be great. And you could also click on that little bell, and that way you would be notified of new videos as I post them. Thanks for watching.